What is up, you guys? Today we're going to talk about bubbles in the stock market. We're going to go over why and how they form, why we should stay away from them, and actually maybe how we can profit off of these. So let's get into it. So a bubble occurs when the price of a stock is overinflated. Basically, every company has a fair value that a set of investors set for that company. And once that gets higher and way far astronomically above what the company is actually worth and what people think the price of a stock is, that is when the bubble happens. So in order to look at this, we have to know the difference between investing and speculating. And this is different for a lot of people, but for me, investing is using a financial and fundamental analysis to find your own value of a stock and what you think the company is worth. You can do this through fundamental analysis. We talk about technical analysis a lot, which is looking at different charts and different candlesticks, but with fundamental analysis, you're actually looking at different PE ratios. You're reading 10Ks and 10Qs and going over balance sheets, income statements, listening to earnings calls, right? Speculation is thinking that something's going to happen or making an investment decision that's not off of, actual fundamentals. So if we take a look at DKNG, a speculation would be saying, I think DKNG is going to go up once sports come back. Another example would be saying, I think DKNG is going to fall right now because of the whole Rona situation. There's no sports besides the UFC going on. I think it's going to fall. That is a speculation. Or even with myself saying that I think Uber is going to be worth $350 a share by 2025 because of AI and because of their taxis that potentially will happen. That's speculating because there is no real fundamental analysis on those aspects of the company. So as of right now, I'm really just speculating. There's not really harm in speculating because a lot of speculation can actually become reality. But what happens is when a stock just becomes more astronomically overpriced because people just want to hop in, and we're going to go over a market cycle in this, that is when a bubble actually forms. So before we look any further at anything, I kind of want to give you an idea of a market cycle. Now, if you've taken any of my courses, I talk a lot about, this normal market cycle that we see, and this is going to be the stages of a bubble. This right here is going to be called your mean. Your mean is essentially what the stock, the fair value would be going up and up and up. And you have what's called the stealth phase or the smart money phase. So market makers, huge hedge funds, companies that see that this stock is undervalued fundamentally, they start to buy into this at this point. Then you hit the institutional investors aspect of this. This is when more hedge funds actually see that, oh, there's a lot of value here in this. We're starting to get a bit of lift off. We're starting to move our way up, and they start to get into this. Then we see the first bit of a sell-off, and this is called a bear trap. The reason it's called a bear trap is because say this stock has been going down and now it's finally found a bottom, or maybe we're starting to go up a bit and people think that this is overvalued. This is a bear trap because people start to get trapped once we see a bit of a fade, and then, people get scared so they jump ship, and then that is when the bear trap happens. We start to move our way up, and we hit the point where media attention starts to happen. Not astronomically overpriced, but things are starting to not be the best deal. And once the public gets a hold of a stock that's, really starting to break out, this is when a bubble truly occurs, and this is when we move into the mania phase. And this is when we start to get enthusiasm. This is when greed starts to happen. This is when, I talk about it a lot, but your barista, your barber, your bartender, they start to hear about this. They start to buy stuff. Like look at Tesla back in January. Everyone was downloading Robinhood. Everybody was buying Tesla at $700, $800, $900 a share. And that is where we started to hit the greed. That is where we started to hit delusion. Then we hit this new paradigm, right? And this is where things start to really take a turn for the worse. Because as we're moving our way up in this market cycle, institutional investors and smart money are starting to get out. They realize this is just ridiculous. I've made huge amounts of profits. The people who got in around this media attention and enthusiasm area, they're starting to take profits. And the people who got in up here, that's not a good sign. And unfortunately, I'll show you how this correlates with Tesla, but a lot of people ended up falling into this trap. And then we get a fade, a big fade, and we get the denial. And this is when people who bought at the top are like, well, I'll just hold it long term. I'll hold it for a while. I don't really care. This is a company I love. And then we get a bit of a bounce. This is called a bull trap. So this is the opposite of a bear trap. And this happens when we get a fade, we get a bounce, things return to normal, but they don't. And all these people who got in at highs try to fill orders that are lower to try to average down, and then a big fade happens, we get fear, and the whole market starts, not the whole market, but in this case the whole market, but the stock starts to really take a fade, and then we bounce below the mean or where the fair value of a stock actually is. Everybody gets out, and I called this with Tesla a while ago. I will link the video below. It didn't do exactly what I thought it did, but it actually moved pretty perfectly as to what I had thought. Now, let's take a look at Tesla here. Let's look at the daily chart. If you could see, let me make this lower. This is not perfect, and you have to remember it. These market stages are not always perfection, okay? You can see here, around when Tesla was at $180 a share, this is when institutional investors and the real smart money, and me, not pat myself on the back, I started buying into Tesla at 180, 200, 220, because at this point the media just beat Tesla down so hard that it was trading way below what the company was actually worth. So I started buying in here. Then we see this big move up, and look at what happened on earnings, right? A big drop. And to me, this is your bear trap, right? This is when we get this big fade, everybody's like, oh, I'm getting out. Because you have to think about it. If you would have gotten in at 170, you could have got out for 57% profits in over a month. That's pretty insane. Then we had this run up. This is where institutional investors say, hey, I'm looking at all of their financials. I'm looking at, they did take a loss on this quarter, but this could be a really good investment at this price. Then we start to get this big move. Then we have earnings. This is important because this is the earnings where they actually were positive for their first quarter ever. And we have this monstrous rip. We start to move. In 3 months, Uber goes from 176 up to 350. Now for me, 350 was like the high side of what the company was actually worth. But then we get into this part, the public part, where the media starts picking it up right here at 357. We start to get enthusiasm. We start to get greedy. Tesla's at $600 a share, and all this happens within 8-9 months. And then this is where it starts to go parabolic, and this is where the bubble really starts to form. And the bubble would be obviously pretty much within this area right here. And this is where greed starts to set in. All of the smart money, all the institutional investors, all the people who know what they're doing are getting out at this point. And the only people buying in at this price are the people who are delusional. And I'm sorry if you were somebody who bought in at that price. I started getting puts. You gotta realize too, we'll talk about this later in the video, that there are people who are trying to get puts on this and they're getting murdered. Just because there's a bubble forming doesn't mean that it's time to just get puts. And we'll talk about that later on. But then you have all these people, and I remember the day I had puts right up here on the exact day. And I remember it was ripping 350. 10 minutes before the market closed on this day, we died 13%. I made some good money on that. I could have made a lot more money. But then we had this bit of a fade. Let's go back to the daily. Here, we had this big fade. And then what happens? The bull trap, right? The bull trap happens. Now in this case, it actually went back and tested highs. So everybody who got in at $900 to $1,000, this took a fade. They got either stopped out or they held and got greedy. They started buying back in. We had this nice push, but then we had, a 63% sell-off in 28 days. And that is a pretty strong, market, overall a pretty strong market cycle. But we have bounced back up near all-time highs right now, and that's because fundamentally now they have 3 quarters in a row that they are profitable, and I think that it's still a little overpriced, but I think that a fair value for Tesla right now is about $600. And now not every market cycle is going to look exactly like this, but we're going to talk about some more coming up, right? So we talked about investing, we talked about speculating, and the real difference of when a bubble happens is people don't know what a company is worth. No offense, but the people who are buying in at Tesla all the way up at $900 back in January, they didn't know what the company was worth. Most of those people probably didn't know how to read financial statements. Most of those people probably didn't know how to, actually value a company. And so speculating is not always bad, but when there's a bubble, everybody can see that from a mile away. And so let's look at some examples. We talked about Tesla. Let's look at something like SPCE. I made a video on SPCE as well, talking about this exact thing. And now when I made it, we had this coming up right here. This is one of those situations where we had, smart money coming in. Some people thought that this would be a good investment. We have the bear trap. We have this moving up. We have this big rip. This is where the public starts really taking off. This is where Facebook groups start pumping out this stock. And then we have this huge move up. And I'm not going to give my whole reasoning why I knew this was going to crash. If you want, you can watch the video. I'll put it down below. But I knew that once earnings came out, this would really correct itself, and it did. We had this bit of a sell-off here. We have this bull trap here, and then the monster sell-off, huge sell-off all the way down. And this is a perfect example of what happens with a bubble. Now, after having 2 earnings, we're stabilizing and we're finding what the true value of something like SPCE is. Let's look at something like MVIS. I hate this. This is not necessarily going to follow this market cycle, but you can really see here that, with MVIS, this is a perfect example of a pump and dump. And we talk about these a lot, but look at this, right? This was all generated off of news. There is no way that a company is so undervalued that it goes up 600% in, 2 days. So this was extremely overvalued. Then we tanked because people realized, oh, this is not what it's worth. And now we're starting to hold off here. Another one would be UAVS. I made a video on this. These types of bubbles occur because the people, no offense, who are investing in these companies don't know. They have no clue what this is worth. It's all Facebook groups. It's all Robinhood Facebook groups. It's all these Wall Street Bets. It's all these types of groups that don't even know how to actually value a company. And if you're somebody who doesn't know how to value a company, you can actually click the link below, become part of our private stock market mentorship. I teach people not only how to trade, and we go over all of my trades, get access to our Discord, but I actually teach people how to value a company long term and how to tell if something is a bubble. So if you want to join, it's only $30 a month up until June 1st. I will put the link down below. But that's how a bubble happens, right? But other things happen on the opposite, where a stock is below its fair value for so long due to news or speculation that you can actually grab that move up. And so once again, let's look at Tesla. But this time let's go to the weekly and let's go to the 3 years. So let's take a look here, and we can see that if we look at the 3-year mark right here, come on, let me get a better view. We have Tesla trading at $380 to $400 a share. To me, at that point, it was probably a little overpriced because we were holding in those levels for a long time. This was before the Model 3 really came out and was pushing the numbers that it's putting out now. This is when it was more so just a man and his dream, and the company was, looked at as a car company instead of a tech company. And so we had the news. We had short sellers killing this. We had the news pushing the stock down, saying they were going to go out of business, saying they were worthless. And look at what happened, right? We had, within half a year, it crashed 51%. And a lot of it was not off of fundamentals. A lot of it was that it was a bit overpriced, but you had the news pushing this stock down. So once Tesla hit $176, the smart money, the people who know what they're doing, they were the ones who were like, hey, listen up. This is really, really undervalued, and we could really take some serious profits away from this if we actually were to get in at this price. And so this is a really, really good time to where you can see something that might be underpriced, and you could say, hey, this is my time to get into this. And we see this happen a lot with different types of stocks. But on the other hand, a lot of times we have something like a CCL that is really, really sold off. This would kind of be the opposite of a bubble, where this is sold off so much that it could be worth getting in. But guess what, right? It's not as simple as to just buy something like this that's oversold, because this was oversold when it was at 35 bucks. This was oversold when it was at $30. This was oversold when it was at $20. But sometimes, right, stocks are oversold for a reason. And for me with CCL, this is down here for a reason, because fundamentally this company is in trouble. And I was an investor in CCL. I've made tons of videos on it before. Another company like these airliners like AAL, these companies, because of the Rona, these are in serious trouble. So these are not one of those things where there's like an underinflated value where, these are probably appropriately valued right now until we get the economy back to where it needs to be. If it's simple enough to see that something is a bubble, why don't we just grab puts? That's another question that I get, right? If we look at Tesla again, obviously this was a bubble. Why would we not start shorting it? Why would we not start getting puts? And the thing is that when you look at something in hindsight, you can say, oh, this is a bubble, this is a bubble. Well, you know, the truth is that the market will act irrational longer than you're going to have money. You've probably heard that before, but if we were to look, Tesla was overvalued at 400 bucks, overvalued at 500 bucks, overvalued at 600 bucks, became a bubble at 700 bucks, 800 bucks, 900 bucks, and it hit $1,000 at some point. It hit $1,000. So if you would have started getting puts at 500, you would have been screwed. You really, really would have been screwed. And the market can just keep going up and up and up and up and up, and the market will outlast your portfolio and outlast your position. So you can't just get puts whenever the market's overvalued. You can't just get puts whenever we have a bubble, unless you time them correctly or you go in with super small positions. And so you can't just be like, oh, you know, market's overvalued, we have a bubble, time to get some puts, you know. And Tesla is a perfect one of those. And now, you know, let's look at, for instance, SPY with the whole Rona situation, right? We had a first case in February of 2000 and, let's see, because the market was so overpriced. We went up 44% from December 2018 to December of 2019. And you can see here on this exact date, this is when they shut down China because of the whole Rona situation. And we only had a 4% sell-off, right? There's one of those things where when people are greedy, that causes a bubble. And we kind of had a bubble in the stock market, and I still think a lot of stocks right now are overpriced. And the reason that we had a bubble was, look, right, we had a 4% sell-off, and then we had this big push up. If you were to look back in January, a lot of CEOs stepped down, a lot of chairmen stepped down, a lot of smart people stepped down because they knew that something like this was going to happen. They knew that when we saw the Rona in China in January, it's not like it's just going to stay over in China and not spread across the world, right? No matter what your views are on that. So the fact that the market only sold off 4% and then we bounced and we made new highs 7 days later when we knew the Rona was out there, when we knew that it was spreading, when we knew that eventually it would have to come to the United States, that's a little crazy. And that is based off of greed, right? The market, bubbles, all of this is pushed by greed, and we should have known that something was going to happen along the lines of this. And then look what happened. We had a 40% sell-off in a month. That's what ends up happening, because I still think a lot of stocks are overpriced. And with where we saw the economy going, granted, not a lot of people thought it was going to be as bad as it actually is, we should have seen this. And this was a classic bubble. Bubbles are created by people, in short, who do not know how to value a stock, who are pushed by greed, who will just buy to try to squeeze out a little bit of profits, and you can't just start getting puts on something like that, guys. And, you know, the best advice I can give to you is to stay away from puts, right? And it's kind of like we talked about before. If something is undervalued, it doesn't mean you should just buy it either. This is why knowing how to value a company is one of the most important things that you can ever learn, especially when you're trading, because even with me, right, I'm taking a trade on Twilio, and I need to know, is this a legit bubble? Is this company actually worth this? You know, even if I'm taking a trade with puts, I have to know, even though it's not going to be a long-term investment, I have to know what the company's worth. I have to be able to quickly look at it and say, like, is this move worth it? Did this happen for a reason, or did this happen irrationally? So if you guys want to learn how to value a company, I will put the link to the private stock market mentorship group in there. It's only 30 bucks a month for life if you sign up before June 1st. And then as of June 1st, it's going to go up to 50 bucks a month. And then as of September, it's going to go up to 100 bucks a month. So get in now while you can. There's over 55 hours of lectures on courses from options, swing trading, day trading, you know, futures trading, which I don't do much of, but I do explain futures. There's so much content in there, and you also get access to our private Discord where me and 209 traders go live every single morning. I live stream. I go over what I'm trading, why I'm trading it. It's an amazing place to be a part of. So guys, the link will be down below. Once again, as always, thank you guys so much for being a part of the community. Thank you so much for being a part of this channel. Hit the like button, subscribe to the channel. It really helps, and I'll see you tomorrow. Peace, guys.